I use the indexes that are pure to what I believe an index is for, and that's a no-fee relationship with downside protection of principal, modest upside, and it has its space.
When you need some advice, never sacrifice, always get it right. Ask the Planman. Finance, insurance, and more.
Hi, everybody. Welcome to Ask the Planman. I'm your host, Bruce Weinstein. I believe each and every one of us needs to have a game plan when it comes to life. If you fail to plan, you plan to fail. Today, we're going to get into a deeper dive on annuities, how they work. We're going to go over the 4 different types of annuity components that are out there, why they might be the right fit for you, and whether or not they're appropriate for your portfolios, give you some more education and guidance there. And I'm joined once again by the effervescent Allie, my producer extraordinaire. Allie, thanks for joining everybody today. We want to get into a little deeper dive. We just had an episode last time on some of the basics around annuities. We talked about the tax deferral components of annuities, but this time we want to give them a little bit deeper dive on the other components. We do have some shorts out there on Instagram and our YouTube channel where we get into variable annuities and SPIAs and fixed and index. So we want to kind of put a bow on it and bring it all together here in a longer episode people can reference as well. So there's 4 types of annuities that are out there. So recap, annuities are a tax-deferred vehicle. The tax treatment on the withdrawal of an annuity is LIFO, last in, first out. So you always want to be conscientious of that. And then there's a 59.5 rule when it comes to annuities, meaning in a non-taxable account, non-qualified, they're treated and have the same penalty as an early withdrawal of a 401k or an IRA might be, and that's a 10% penalty. So yes, you can get your money out of those vehicles. You can get your money out of the annuity earlier as well as your IRAs, but the government doesn't want you treating them like an ATM. Hey, I need tickets to Taylor Swift. I need $2,000. Let me go take money out of my 401k. Like, they don't really want you doing that. So same here with the annuity. So we've got a fixed annuity. Fixed rate annuity is like a CD. CDs are going to be taxable to you in a non-qualified account. They're going to have to pay tax on the income. You're going to get a 1099 every year from your CD. If you're $100,000 paying you 8% on your CD, you're going to get an $8,000 tax liability. Means you can't spend the $8,000, you can't reinvest the $8,000, you got to pay the tax. You put that same money into a fixed rate annuity at 8%, you're going to get $8,000 on your anniversary, you get to roll it over and keep the whole $8,000, let it compound for the second year at 8%. Beautiful thing. So compounding of money is very important. And yes, those dollars do add up, and keeping the money in your pocket for a 10, 20, 30-year window and not having to pay taxes as you go certainly will impact the back end of the volume of money you've accumulated. The next annuity is probably one of the most popular ones, is an indexed annuity. An indexed annuity allows you to get, let's call it stock market participation. The term index is because you're using a variety of indexes that are offered to you. Probably the most common would be the S&P 500. And you're going to get a percentage or a level of participation against the performance of the index you've selected. You could be more aggressive, you could be more conservative, but the S&P tends to be the most popular. We just did some reviews. We had clients we did an indexed annuity for 2 years ago when rates were still pretty low. Mortgage rates were 3%, and her indexed annuity had a cap of 4%. The most she's going to make is 4%. Which by today's standard, well, now it looks pretty anemic, but back then 4% was pretty good. With the rise in interest rates, mortgage rates hit 8%. I think they pared back a little bit to in the 7% range, a little bit less. But the annuity companies, because of the rise in interest rates, just like the banks, have raised the participation levels where now we're getting clients 10% participation, maybe even more. So this past year, the S&P 500's had a double-digit performance, maybe, I don't know, I would have to Google it, but you're probably in a 20 to 30% range for the stock market this year. I think it was a pretty good year. So your index is going to hit that 10% cap. You're going to get a 10% credit to your deposit. And then you get to reset it and do it again next year. And usually they're what's called point to point, 1 year. Some of them might offer a 2-year window, but every year it resets. If you have a 1 year point to point, basically says, I put my money in October 1st. My clock starts October 1st. At September 30th, my year is over. How did the market perform during those 12 months? If the market had a correction in August, I could be in deep doo-doo. I gave back my whole year's worth of performance. Then you get a Santa Claus rally in December. Well, that 1 year is over. That's going to count towards your second year. So everybody has their own clock when it comes to an indexed annuity. It's not an annual number per se, January 1 to 12/31. It's your own clock. They got your money on a Tuesday, November 18th. That's your clock, November 18th. Okay. So that gets set and established. Indexed annuities, you could probably find some around 5-year, 7-year, 10-year contracts. The longer you go, the higher the participation. We touched on that in our previous episode. You're basically giving money to the annuity companies, their insurance companies, and they're investing the money. And they're going to work and look for the spread between what they have to give you and what they can make for themselves. The longer you give them, the more risk they can take. They have a little bit more protection because it's longer term. They're willing to give you a little bit more. If they have to return the money in 5 years, they're going to give you a little bit less. Okay, so the rates and the programs are going to vary based upon timing. So some people might use a combination of a fixed annuity and maybe buy 1, 3, 5-year, kind of like CDs, ladder a CD using the fixed annuities. And then on the back end, pick up some indexed annuities for 5, 7, and 10. And now they've got a laddering of annuities, different rates, different performances, different timelines, structured 1, 3, 5, 7, 10 years out. Over the years, I've done CD laddering. That's usually the client, will go to a bank and buy CD ladders 1, 2, 3, 4, 5 years, 6, 12, 18, 24 months, whatever it might be. And then based upon their cash flow, they just roll the CD out to the longer cycle. So a lot of people, cash management needs a discipline and a strategy, just like your stock portfolio. So if I've got a certain amount of money in cash that I want to keep, well, how can I maximize that? So if I have a 1, 2, 3, 4, 5-year ladder, whether it's using the annuity or a CD, a 1-year rate is usually lower than a 5-year rate. Historically, that's always been the case, right? The longer you give the bank, they go give a 5-year car loan out, they make more money on it. If it's a 1 year, they're going to pay you less. Well, I don't need all my money coming due in a year, but I need some of it in case of an emergency, right? So I have some cash. I have a 1-year CD, a 2-year CD, a 3-year CD. So I'm getting varying interest. I'm also hedging the interest rate risk if rates go up or down. But now at the end of the 1 year, I'm going to roll out that CD. If I don't need it, I'm going to roll it out to the longest end and replace the 5-year. Because last year's 5-year now has 4 years left. Now, historically, the 5-year rate's always higher. So if I'm constantly rolling out my 1 year for a new 5, I'm ultimately going to bump up the total interest on that account. And again, the same you can do here using your annuities. A 1 year, 2 year, 3 year, 4 year, 5 year, 7 year, 10 year. And so now if you don't need the money, you might say, well, I could take that 1 year annuity and roll it into a 5 year or even a 10-year indexed annuity and get more bump. And eventually, as the ladder is rolling up and down, now they're just constantly buying a new 10-year, knowing every year one's coming due if they need it. If they don't need it, we're going to roll it out. If they need half of it, they roll half of it out. So it's just a matter of managing the cash flow. That was very important in the early 2000s as interest rates went from 8% to 5%. We had clients locked in for 5-year CDs at 8%. When the 1 year came due, well, the 5-year wasn't 8% anymore. The 5-year was 5%. But they still had 4-year, 3-year, 2-year, 1. And eventually, within the 5 years, all those 8% CDs got replaced at under 5. And then 07, 08 came along, and the 5-year CDs went down to 1. And now we had a problem. And we talk about that, and we're going to talk about this in one of our future episodes about your X factor and your lines crossing and what happens in that regard. because a lot of people, look, there's the little old lady out there that just wants her money in CDs or fixed annuities. They don't want risk. They want liquidity. That's all well and good until the rates go the opposite way. But I digress. So we got index annuities. We got a little bit of a strategy using the ladders. Now we have SPIA. We touched on SPIA before. SPIA is kind of how the annuity world provides income stream, lifetime income. That's be where your pensions might be derived using a SPIA. If you won the lottery, we touched on this last episode, lottery winnings are nothing more than annuity payment and annuity calculation. It's discounted to get the lump sum today in exchange for those payments. So a $100 million lottery winner might only get $65 million lump sum. And they're going to pay the tax on the $65 million, and they're going to walk away with $45 million or whatever it is, right? So I always say the lottery is good. It's a beautiful number, but I'm going to get a third. Like, I'm a lump sum guy. I want the lump sum money. I want to do what I want to do. I'm depending on interest rates, always thought I would take the lump sum, especially rates of 1%. So my math is it's a third. I'm going to get a third after tax. If I won 100 million, I'm going to get about 30, 35 million. All the lottery commission's doing is buying a SPIA for that 35 million. Well, a little bit more, I guess. I got to put the tax back in. So they're going to buy $50 million. They're going to buy a SPIA for me to pay me the next 20 years, that $5 million a year to get me my 100 million back. So it's just a matter of risk management. Do you want to manage the money or do you want them to manage the money? The annuity company is going to manage the money. They're going to give you an interest rate based upon prevailing rates, and they're going to make you an offer. Here's the lump sum. Here's the cash annuity payment. So that 100 million, you want to wait 20 years, you'll get your 100 million paid out, 5 million a year for 20 years, let's say, and you'll pay the tax as you go, and you'll be on somebody else's control of distributing your money. Conversely, if you're a astute investor, yes, you pay the tax, but if you could take that 35, 40 million, can you do better than what that income stream is going to net you and have control of the asset in day one? But unfortunately, as we all know, most lottery winners go bankrupt within a couple of years of winning. So maybe the payments are the better method, right? The devil you know. SPIAs are great for DINKs and SINKs. We've got episodes where we talk about double income, no kids, and how a couple without direct heirs, most parents will want to leave money to their kids. So a DINK and a SINK, single income, no kids, double income, no kids, their priorities are different. And so the game plan is going to be for them of how can they spend their money down as close to zero before they perish and leave this earth. And that's the age-old challenge, right? Is how do I not run out of money, but how do I not leave too much behind? And what could I have done different or better? And how do I build a better mousetrap? And of course, my sarcastic answer is you tell me when you're going to die, and I'll give you the perfect financial plan. There is no expiration date on our toes, right? Like milk. So if I had an expiration date, I could come up with a pretty good plan. So a SPIA is a good way for a DINK or a SINK to take that asset and create lifetime income. Not worry about the risks of the market, not worry about changes in their cash flow, not worry about corrections and changes in interest rates. You're locked in. It's guaranteed payments. You know exactly what's going to come in. And when you die, the payments stop. If you have a significant other, you could do lifetime income, joint lifetime income and continue it. A SINK, obviously just on the one person. So that's where SPIAs can come in. And then third and fourth would be your variable annuities. Now those require securities license. We are not securities licensed. I've done tens of millions of them over the years when I was securities licensed. It has its place in people's portfolios. You have to understand how they work. I'm not going to dive too deep into it because I'm not licensed in that space anymore. You could talk to your investment professional, but a variable annuity in and of itself gives you the options of managing and building a portfolio aligned with what would be deemed mutual funds. They call them separate accounts, but they're mutual funds. So you could have a Fidelity fund in there. You could have a Putnam fund in there. You could have an AIM fund in there, an Oppenheimer fund in there. Are they the exact same fund? They're mirrored to the fund. They're managed exactly the same. The technicality is they're called separate accounts. So you can build a portfolio. You can take a lot of risk. You can take minimal risk. You can get living benefits on these things. You can get lifetime income benefits. You can get minimum guaranteed performance. Like there's a whole bunch of acronyms that are available now in the variable space. There's a couple of drawbacks on variables where you hear people like the Susie Ormans out there and the Dave Ramseys and the Ken Fishers out there blast variable annuities. And that's the fees. You have what's called drag. Anything in your portfolio, mutual funds, have fee structure. That's drag. You pay a portfolio manager. That's drag. That's why the index funds are so popular. The Vanguard S&P 500 has literally like 0.1% annual fee. Well, most portfolio managers are probably going to make at least 1%. So right off the bat, you're saving 0.9. Multiply that by 40 years, it's a lot more money. So people are very fee conscientious, and a variable annuity is going to have 1 to 4% built-in fees. As well as, Allie, you take all the downside risk. The market corrects 30%. You lost, if your funds are mirrored to the market, you lost your 30%. Oh, by the way, plus the management fees of the annuity. And so that's the knock. Whereas an indexed annuity has no fees. I didn't say that earlier. Let's say it now. Indexes have no fees, although, again, I got to be careful. There are products out there now that leverage some fees for extra performance. And so that side of the industry is now masking or mirroring a way to give people a bigger jolt. But I don't want to do those products. I won't use those products. If a client wants more juice, go talk to an investment advisor. I'm looking to use safe, protected assets. No fees, no downside risk. The ones with fees have some downside risk. The one with fees might get higher performance. That's not my end of the swimming pool. I don't want to dance over there. Okay. But I use the indexes that are pure to what I believe an index is for. And that's a no fee relationship with downside protection of principal, modest upside. And it has its space. A variable annuity has so many components, a lot more upside. You take most, if not all, the downside, and you have a higher drag. But again, I've done, in my estimation, I probably in my career put over $50 million into variable annuities as a financial advisor when I was managing money, and it's had its place. It had features that protected people. We went through different stock market crashes and cycles, and those products and programs protected my clients and provided them guaranteed income streams later on, even though the portfolios went down. So you have to understand how they work, and that's part of the problem is how does it work? And most people don't understand it. So, but again, that variable comes with a different license and a different conversation from an advisor. And that's just not something that I do anymore. I can certainly bring in people that do that work for them and sit at the table, but no, I'm not compensated nor will, advise people directly on it. So those are the 4 types of annuities that are out there and some of the strategies that might go with it. Did you have a couple questions you wanted to toss out, Allie?
Well, so the biggest thing to kind of bring up is something we were actually talking about earlier before we started recording. And that was kind of, there's a debate right now on IULs versus annuities. So I'd love for you to weigh in on that. Sure.
So IUL is an indexed universal life insurance. And so what Allie's alluding to is some of the terminology that is out there these days. People might hear from a marketing standpoint of be your own banker or infinite banking. And so the fundamental is this to start, is life insurance and annuity products go back, life insurance at least, goes back over 300 years to jolly old England and the Widows and Orphans Act. And so England being a seaworthy, commerce, right? A lot of ships, a lot of sailors exploring the free world, the new worlds, right? They sometimes, a lot of cases, daddy didn't come home. And the Widows and Orphans Act basically, literally in the 1600s, 1700s, was a way to get the families to buy some form of life insurance. And again, we touched on in some episodes that today's income tax levels are not what they used to be 50 and 100 years ago. And if you're a student and understood, there's a Beatles song about the tax man. England used to have a 95% income tax rate. You literally kept 5% based on how much money you made. And so if I had to buy life insurance and you're going to take 95% of it, why would I buy it? That didn't seem fair. So the Widows and Orphan Act made life insurance proceeds tax-free when paid. So if dad goes out to sea and he's got 3 kids and his wife and he buys $500 worth of life insurance, the Queen or the King of England wasn't getting 95% of it. It would all go to the spouse. On top of that, from a investment standpoint, the cash value accumulation, these are whole life policies back then. Eventually, universal life came about, but a whole life policy has a cash accumulation feature that was a savings account. And just like the annuity, it was tax deferred, which is how annuities get their tax treatment. It's all based upon life insurance. That's why they're issued by insurance companies. Okay. So you've got the umbrella for tax protection using life insurance and annuities. However, annuity has a 59 and a half age restriction for withdrawal. And annuities don't have any borrowing features. So it is what it is. It's a pretty much straight up vehicle, usually left in there till 59 and a half. It's construed as a retirement account, retirement vehicle. And similar to your IRA and 401k, has an age 59 and a half restriction to avoid a 10% penalty. Ergo, the conversation and the popularity increase of using these IULs or whole life in this infinite banking, be your own banker phase. And basically what people are doing is they're leveraging the tax rules of life insurance, which is tax deferred and or tax-free growth. And they're overfunding their life insurance. So there's a basic contribution you're supposed to make to cover your cost of insurance, COI, fees, and then accumulation, meaning money that's going in to the cash value. And the cash value is important for a certain level of growth over time so that the policy doesn't lapse and blow up. So you're supposed to, in a permanent policy, have cash value accumulating over time to keep the policy from ever failing. And so they're now overfunding that minimum to a certain point, which is now earning interest. An indexed universal life, there's variable universal life, which I did a lot of in the early 90s. Now the index is certainly more popular. It works in the same vein as an indexed annuity, and that is there's no downside risk. You get upside performance. You're picking an index. Again, there's a corridor of performance. There's not unlimited upside, and there's certainly no downside. But if you can make 6, 7, 8% consistently on your money, it's growing tax-free, or at least tax-deferred. And then all the proceeds of life insurance pays out tax-free. But here's the key component. There's no 59 and a half age restriction. And life insurance allows you to borrow against the cash value. So people have used these over the years to build a pension for themselves. They've used it over the years to fund for college. And now this infinite banking is basically like, look, you could buy your home using this. You could buy your car using this. You could lend money to people using this. Like, there are younger people. There's a whole movement now where people are putting in $200,000-$300,000 of excess cash, getting the interest on it, and then borrowing it back to do other transactions, to buy real estate, to buy their car. And so you're paying yourself back. You're the banker. Be your own banker is one of the things that you hear. How do you be your own banker? Well, If I don't have the money, I got to go to the bank and borrow it, and they're going to charge me interest. I have to have money. I got to fund the insurance policy. I have some extra cash I put in there. Now, when I want to go buy a car, instead of going to the bank, I'm going to go borrow it against myself. And so what happens now is there's, like everything else, there's spreads. I'm going to have an interest rate on the loan of X, but the cash value is still earning interest. And then what's the spread? Now, maybe the spread's 2% negative. But if a car loan is 7.5% and I could borrow my own money at 2%, be my own banker. I'll borrow my own money. It's cheaper. Or if the account's performing above the loan rate because the markets are good, I could still be making a positive return on my money. Does that make sense?
Yep, that makes sense.
The big difference from the annuity goes back to the 59 and a half age issue. Now, if you take money out of your annuity, we touched on earlier that the tax treatment is LIFO, last in, first out. Well, it's very similar, or it's exactly the same when you're dealing with life insurance. So we just said the magic word before is they were borrowing against the cash value. They didn't withdraw the cash value, because if they withdrew the cash value, that's a taxable event. It's a LIFO treatment. So you're going to borrow against the principal, assuming there's interest and growth. Okay. Now, one of the things that I've done, and maybe this isn't the form, is I've built over the years for clients private pensions using this concept of overfunding their life insurance, having the money grow over a certain period of time. They put the money in for like 20 years. Now, the difference is that they're not their own banker in the sense of they're touching it during the 20 years. The people doing this infinite banking, be your own banker concept is they're putting money in with the intent of taking it out pretty quickly. They want to start getting into other transactions. And so they fund it, they let it grow a year or two, they start pulling it out and doing things. When I did my private pension, I might have a 40-year-old doctor that's going to work for 20 years. He's going to fund this life insurance with $100,000 of excess capital, which, by the way, he couldn't put in his 401k or his IRA, right? So he wants to save a chunk of money. We overfund the life insurance. And then at the end of the 20 or so years of accumulation, they now take income. And the way it's designed when I build my private pensions for clients is we're going to create a tax-free income stream for you. And you're like, well, wait a minute, how are you going to do that? You just told me that it's LIFO and you have these tax implications. Well, that's, again, the beauty of the life insurance. And so the terminology here, if you're taking notes, is surrender to basis, switch to loans. And most financial advisors never heard that phrase. Surrender to basis, switch to loans. So let's go down that rabbit hole a little bit. So if I built up a private pension life insurance IUL for a client and they've got $2 million sitting out there, they put in, just keep it the math simple, they put in $1 million from the growth of the account, it's got $2 million. We're going to pull out $75,000 a year. The first $75,000 is going to be structured as a surrender to basis. What's the basis on the life insurance? The basis is the accumulation of the premiums paid. I said he put $1 million in. So his 20 years of savings, his basis was $1 million. He's allowed to surrender the policy. Now, surrendering the policy means he's going to lower his death benefit. If he has $2 million of cash value, let's say he has $3 million of life insurance, because there's a corridor there. He's got to have, still has life insurance somewhere in the mix. So he's got $1 million of his own money in there. He's got $1 million of interest, and he's got $1 million of extra life insurance. If he died, the family gets $3 million, but $2 million of it was already his. So did they really get $2 million of life insurance? No, he put the money in, he made money on it. They'll get a $3 million death benefit, no taxes, no obligations, right? There's a estate planning conversation, but we'll leave that off. From an income standpoint, his wife, his kids, whomever, they're going to get $3 million without tax. Widows and Orphans Act, not taxable income, okay? But he's got $1 million of life insurance built in there. So now he's going to take his, are you sorry you asked this question? He's going to take the first $1 million he put in and he's going to surrender to basis, and the $75,000 is going to come out every year tax-free till he uses up the first $1 million. Make sense so far?
Yep, I'm following.
Okay. So now going to hit the next quarter. Now the account's still earning interest. The cash value still growing. He's surrendering the basis. The interest, everything's still earning interest in there. So that extra $1 million is still growing. Well, now, again, all this stuff is illustrated and calculated beforehand, so you know what you're getting involved with and where the corridors are for these things. But, we've solved for it in that regard. And so now that we've surrendered to basis, we're going to switch to loans. We're back to the concept of borrowing against the cash value. Borrowing against the cash value is not a taxable event. So just like the infinite banker who's borrowing the money to get his car, he's taking out money free of charge from the life insurance. He's going to pay the spread between what he earns and what they charge on the loan, but it's calculated in there. But most importantly, he just got $75,000 of more tax-free income. It's a loan against the policy. And again, now you're spending down using the cash value. There's calculations, but at all times you have to make sure the policy doesn't lapse. LAPSE. If the policy lapse for underfunding, all those loans suddenly become taxable. So if you're going to use a vehicle like this, you have to make sure it's funded enough. And that's what we would really call a very bad day if somebody's policy lapsed. So in all of the calculations you're doing in the illustrations is you have to make sure it's got a booby trap. And there's actually a company out there that booby trap proofs that their policy is guaranteed never to lapse. So we tend to use those more than the others, right? Because always want to protect the client. So surrender to basis, switch to loans is a way to guarantee tax-free income for people using this concept. So I've been doing these things for like 30 plus years. Now it's more in vogue, this infinite banking, be your own banker. People are using it for more short-term needs, taking advantage of the same rules. It's the Widows and Orphans Act. It's 300 years old. These are the tax laws that we instilled from jolly old England, and we use it today. And that's why the insurance industry is as large as it is and why insurance products are as large as they are. And then, again, this is not a total life insurance show, more of annuities, but most businesses, corporations, banks own multiple millions of dollars on all their executives, all their C-suites, key man insurance and the like. And there's a whole methodology to all of that we won't get into. But life insurance is, people, the average person out there doesn't understand the sophistication of what they can do with life insurance. And it ties to estate planning, premium financing. We've got episodes on. So we get into this in all kinds of other shows, Allie. So, certainly we can have people reference Ask the Planman, go to planman.tv, but you could check out a lot more of our episodes on some of these other topics. But that's our deep dive for annuities. What other questions did you have before we wrap up?
I think we covered a lot.
I'm exhausted. The girl gets me talking. All right, I'm going to bring it home. You don't have anything else?
No, I think we're good.
All right, folks. So let me recap for you. So we're giving you a little bit deeper dive on the 4 types of annuities: fixed, indexed, SPIAs, variable annuities, 4 different types of programs out there, the tax treatments, the tax implications, the LIFOs versus the FIFOs, the 59.5 age restrictions on there. We kind of segued a little bit into being your own banker and the comparisons of using an IUL versus an annuity, where and how you could potentially do that. So it is another alternative for you in the world of tax deferral. I tie in some of the strategies I've used in building a private pension. So if you have any questions on any of these, certainly feel free to reach out to me at 844-PLANMAN, Bruce at asktheplanman.com. Come find us at asktheplanman.com or planman.tv. We're on Instagram, Facebook, LinkedIn. We're everywhere you can find. So just Google Ask the Planman. Remember, folks, if you need some advice, always get it right. Ask the Planman. If you fail to plan, I'm guaranteeing you're going to plan to fail. Make sure you have a plan. Be proactive. Stay safe. Until next time, I'm your host, Bruce Weinstein. Thanks for joining me.
When you need some advice, insurance and